And I have to say, my largest holding of all my assets is gold. That I have to say, and I will never sell it.
Dr. Marc Faber, welcome back to the channel.
Well, thank you very much for having me. And I wish all your viewers a prosperous new year.
Well, thank you. It's always a pleasure having you on. Always very informative and very entertaining as well. Last time you were on the channel, it was over a year ago, and you were making the point about basically the fragile state of which the global economy was in, and in particular the US, and how things were not looking good. We had significantly higher inflation rates at that stage. We're now in a situation where we've got the Dow Jones at all-time highs, S&P similar. Inflation has come down. It's about half what it was last time we were talking. Is this a case that markets can stay irrational longer than one can stay solvent, as Keynes would put it, or is this something different? Have the Fed managed to save us all?
Let's put it this way. I think that the markets have surprised on the upside because most observers of financial events, including myself, thought that through the increase in interest rates, liquidity had tightened or would tighten, when in fact the increase in interest rates in the US certainly, but also in Europe, occurred from such a low level to start with, because in the EU we had negative interest rates until 2022. So we had this increase in interest rates, but financial conditions did not tighten. And it reminds me of an argument Milton Friedman made, and it is also my observation. Say you look at Turkey. Turkey has an inflation rate of around 100%, and interest rates are at 100%, but money is not tight. The absolute level of interest rates tells you nothing whether money is tight or not. What tells you something about whether money is tight or not is that in a tight monetary environment, the stock market doesn't go up normally. And the bond spreads widen considerably. In other words, junk bonds decline much more than treasuries. And in a tight monetary condition, the VIX index soars, goes up strongly, but we are near record lows. So what the Fed did is it increased interest rates, but it made money available to the banking system through all kinds of facilities. And therefore, money didn't become tight. In fact, from the October low, 2023, until today, monetary conditions have been extremely expansionary. And as a result of that, I think that inflation will not come down much, and actually in the second half of the year accelerate.
Yeah, I mean, we've seen inflation come down, and the latest figure is about 3.35%. But with continued inflationary monetary policy, loose conditions, we are bound to see that tick up again soon, are we?
Well, I'd like to explain to your viewers exactly how these figures come about. Say, you and your viewers' households and my household, our cost of living is up about between 15 and 25% vis-a-vis 2019, 2018. Everything has become more expensive. Your insurance premiums, food, and whatever you buy is more expensive. And after this bout of inflation of, say, 20% increase, we have a year during which prices don't go up. Then the Fed can say, well, we conquered inflation. We led to policies that have produced lower inflation rates. We can now ease. But the fact is that the price level is still 25% higher than 3 years ago. That nobody can deny. And if the prices didn't go up a lot, the quality has gone down, like walking through an airport or lining up at immigration counters and so forth, or in the packaged food industry, the packages are smaller.
We're seeing a lot of shrinkflation.
Precisely. I mean, I looked at the chart the other day. It's the price of a Campbell soup over the last 100 years. It's a beautiful measurement of inflation because the product is exactly the same. The size of the can is exactly the same. Maybe it's too expensive to buy machines that produce smaller cans, but the price is up like since 71 by about 12 times.
So we're going to see.
I used that chart to show that actually the price of gold, and I have to say, my largest holding of all my assets is gold. That I have to say, and I will never sell it. Because when I look at central banks, it's a horror show. I mean, as anyone who trusts these liars and misleading characters and shady characters and people who've never worked in a private job, who could trust them? So I hold gold as an insurance policy, but I don't think that the gold price is all that cheap.
But
when I compare my cost of living in 1950 and today, I have to say that the gold price is about where it should be.
Saying that, then, okay, if you think the gold price is where it should be, why is it that gold is your largest holding and you're never going to sell it?
I said that it's an insurance policy and that I regard it as a safe asset.
If we go back and just talk about the stock market for a moment, we've seen, and if we just take the Dow, for example, we've got that at 37, nearly 38,000. Are we looking at there basically that as being another measure of inflation, or is that underlying performance of the economy or stocks? Or is this just a case of the dollar continuing to lose value as measured in terms of stocks?
My sense is that the global economy is in recession, if it were measured properly. The Asian markets have reflected this poor performance of the global economy. But the Western markets, as I said, they're driven by liquidity. And so there's a huge divergence between the valuation of stocks and the real economy. Number two, we have assets that are equally inflated, like home prices around the world. Now, the interesting thing about home prices is that commercial properties in America, in most cities, is down around 40–50% from the level in 2014, 2018. So it's interesting because some people think, oh, there is inflation, everything will go up. No, this is the viciousness of inflation, that in an inflationary environment, certain asset prices decline. It can also be a currency that declines or so. But it's interesting to see that a typical asset that people expected to go up in inflationary times declines by 40–50%.
And what do you think underpins the reduction in commercial property? I know that there has been talk over the last number of years of effectively these being overvalued on the books of the asset holder as such. And now it's kind of, as the tide goes out, we see who's not wearing any shorts in that regard.
Well, my sense is that there was some overbuilding, I suppose, business is not as great as the Biden administration advertises. And there is a structural change in the sense that young people work from home. And in America, a lot of people move to the countryside or to the suburbs. Then they don't want to come every day to the office.
Mm-hmm.
This is different in Asian cities like Seoul, Tokyo, Hong Kong, Singapore, any Chinese city. People live on very small space. They love to go to an office which is clean and nicely decorated in the center of a city, and then they can go and have lunch with their friends, and then they go home. So this trend of working from home is in Asia less pronounced because people enjoy going to the office. They don't want to stay with the grandparents and parents and children all in one room.
Mm-hmm. There seems to be a laundry list of things that we could choose from as being the catalyst for a recession or something even deeper, or even the catalyst for a banking crisis. Obviously, what you're talking about there in terms of commercial property and the loss in value of commercial property is going to have significant impact on the banks that are funding those commercial properties, and could be the cause of another potential liquidity crisis. Do you agree with that? As in, do you agree with that thesis that we're going to see a banking crisis, and it could potentially be caused by property markets or commercial property values being revalued?
It's possible, but I don't think it will happen. I think the Fed is aware of the problem, but the Fed is in a different condition regarding residential properties. You understand? Residential properties. We had a colossal real estate bubble in 2007
mm-hmm.
based on subprime lending and so forth. But now property prices are much higher than they were at the peak in 2007 in most American cities, in Canada as well, and so forth and so on. And so the affordability has collapsed. At the present time, the lowest percentage of the population can afford to buy a new home. The affordability is extremely low. So my theory is that the Fed, they will continue to print money, because there are two ways to go about the gigantic debt. There are three ways. Increase taxation. They're not going to do that in an election year. And two is default, and three is essentially by paying tax through inflation. Inflation is a tax on the system.
Mm-hmm.
It's a very unfair tax. It touches the poor people and the middle class much more than rich people. Rich people, like who have assets like myself, they benefit from inflation because our cost of living also goes up, but our assets go up more than the cost of living.
So the cost of living for lower income and middle class, the cost of living is a much higher percentage of their take home pay or their annual income.
Absolutely.
No.
So the whole subject is very complex, and everybody thinks, well, asset prices will collapse. This is not necessarily my view. Selected assets have already collapsed, and others will in future. I would think that the FANG and FANG-related stocks, the Magnificent Seven, are very vulnerable. But at the same time, if you look around the world, there are European stocks, and especially stocks in emerging markets, that are very depressed. They're very inexpensive, especially relative to US stocks. So investors should, aside from holding precious metals for the safety aspect of precious metals, also hold selected emerging markets, and gold shares relative to the US market and relative to the price of gold are incredibly low.
We've seen gold go to an all-time high, and we have seen basically gold mining shares still be in the doldrums.
It's a disaster. Partly because they're very badly run, and partly because they're run by dishonest people.
Okay. You touched on, just if we were to go back and talk about, say, the national debt, we got, we're over 34 trillion at this stage. One of the only tools left for the Fed to be able to stomach national debt at a level of 34 trillion and growing is to inflate away that debt. So
correct. Only way.
We are looking at a situation of prolonged higher inflation for a number of years in that case, aren't we? But also, something's got to give.
Look, in Argentina and in Turkey, they had inflation of 100%. You go to Istanbul and walk around. Nothing strikes you as unusual. Everything can be indexed. The problem occurs, of course, at some point. But in Germany, 1918 to 1922, inflation accelerated in 18 and 19 and then took off in 1922. So it can take, a few years until the breakdown occurs.
So we're only getting a taste of it at the moment, is what you're saying?
Yes. I mean, my sense is nobody in America can go to the American public and say, look, we have to tighten our belt. The government expenditures have to be cut. The pension funds, pension of the firemen and the policemen and of the veterans, we have to cut them by 30%. You think this guy will get elected? No way. Politicians have to lie to the public that all is well, otherwise they don't get elected. But I'm telling you, the situation with the debt in America is a huge problem in the long run because the interest payments at zero interest rates was low. But now that interest rates are around 5% on the 10-year treasury, the interest payments go up like a rocket. They're around now $1 trillion a year.
So
$1 trillion.
It's a staggering number. And what you're suggesting there is obviously there's an outstanding debt that rolls over. There's a kind of a maturity profile to it. So each year, a lot of that debt is being replaced with new debt, and the old debt is rolling off at 0% rates, and the new debt is coming on at much, much, much higher rates. So therefore, correct, the actual interest payment, the annual interest payment, becomes a much more significant part of the annual budget, and you're not getting anything for it, and it has to be funded.
The problem is Congress. Both parties are spending money like there's no tomorrow. There's no restraint. And now, Biden may wish to have a war in the Middle East because under war conditions, the sitting president continues to be in office. So I would consider this to be a big issue politically, and that this would obviously be very favorable for precious metals. Okay. I mean, a year ago, if you had talked to me for the last 40 years, every year I would have told you that I increase my gold position. I've never sold any gold, and I've always bought every month's gold. And now I have a very large position, but I'm a bit afraid of governments taking it away.
In terms of
I have not sleepless nights because of that. I mean, I've seen so much horror in wars and in amidst tensions and unjust actions by governments, maybe it will touch me one day as well.
Now you say your gold or precious metals are your largest holding. Generally, what would you recommend for somebody as a percentage holding in precious metals to fulfill that role of insurance for them?
Well, I have approximately 25%. Then some gold bugs, they accuse me that I don't have enough gold. but you see, I don't think that gold is the best performing asset. It's probably the best store of value. You understand, over longer periods of
Indeed.
time. But what is the long term? Because you and I and everybody will die after a given time, sometimes sooner, sometimes later. So who knows? But I believe that in the stock market, you can make more money than in gold.
Mm-hmm.
But you have to be very careful and you have to be very astute and follow stocks very carefully and not buy SPAC stocks at the peak and meme stocks at the peak and unicorns at the peak and technology stocks in year 2000 before they dropped 70% and so forth and so on. So overall, if someone wants safety and sleep peacefully and go and have a pint of beer in a bar, then gold is quite a good tool to achieve that financial goal.
Indeed. We had Rick Rule on the cheers. We had Rick Rule on the channel a while ago, and the way he put it, obviously he's a big fan of precious metals, but the way he put it is that having gold in his portfolio allowed him to take risks with the rest of his portfolio that he wouldn't otherwise do.
Mm-hmm. Well, in my case, I started to work in 1970, so I could invest part of my money in the early 80s at between 10 and 15% in bonds. So you understand, if you have a portfolio of stocks and you have on the bond portfolio a cash flow of 15%, you can absorb volatility. If you have zero interest rates, and that is the crime of central banks, young people, they had no possibility to save money. I mean, I could put my money, I started in 1970, starting at 6% up to 15%. Yeah. And yes, we had inflation. But in my view, the inflation today is more persistent than the inflation we have in the 70s, because in the 70s, it was mostly a favorable inflation, labor earned more, and two, it was commodities inflation that after 1980 abated. And now it's a lot of service inflation.
Mm-hmm. Mm-hmm.
But anyway, to give you a summary of my assets, I have real estate. I have real estate in Switzerland and in Thailand and in Vietnam. And I have stocks. And I have stocks in Latin America, now quite a heavy weight, because if World War III happens, Latin America should be safer than, say, the Suez Canal real estate fund. And I have also stocks in Asia, because I think that Asia is cheap. I have stocks because in Thailand, because I live in Thailand, I believe one day maybe you won't be able to remit money from country A to country B. So I want to have my own cash flow here in Thailand. Mm-hmm. I also have cash and bonds. I don't think they are good investments, but I never invest in the belief that I'm always right. I could be wrong. You understand? We could have a serious recession in 2024. So I have cash and bonds. and I have precious metals, as I mentioned, but stored in different locations, not in one place. And also my stock holdings are not all in one bank. They're in different banks, in different sovereignty. Because if you're Irish and British or UK, Australia, Canada, you're all a vassal of the United States. That's what you are.
So you're geographically diversified as well as diversified across asset classes
Correct,
as well.
Correct. Yes, that's what I am.
Okay.
And I've gold in bars and also in small coins, because when the hell will break loose, if you go to a department store, you can't pay with credit cards because they will switch off the internet and the electricity. So you need small denomination gold coins.
Okay.
One form of money is, of course, cigarettes. With cigarettes, you can pay everywhere.
You're spending your cigarette money there at the moment. Talk to me for a moment about the Boom Doom Gloom report, if I've got the order right.
The Gloom, Boom, and Doom report is, and I have also an abbreviated version, is a monthly report. Both appear monthly, 12 times a year, and highlight some unusual opportunities. But these reports are only for people who have time to read, and also for people who are willing to learn beyond whether the stock market goes up tomorrow or down tomorrow. You understand?
Indeed.
The investment world has become very complex and has to do nowadays much more with geopolitics, with geography, with regulation, with government interferences, with economic policies by central banks than before. And so I believe that it's very important for the reader, in order to understand the financial market, to be well educated. And I believe that, in all honesty, if someone reads my report for 3 years, he will have more knowledge than someone who went to an American university, take an MBA at the cost of over $100,000 a year. And the website is gloomboomdoom.com. Gloomboomdoom.com, all in one word. And you can find it also by Googling my name, Marc Faber.
I'm gonna put a link to that website in the show notes and description beneath this video.
I'm not into the advertising business. I think people have to decide themselves whether something is suitable for themselves, whether they have the time to, because I refer frequently to things that people should read in order to understand the issue. And so I think that each report, someone who should have time of about 2 hours to read that report.
Okay. If I ask you this, put you on the spot, if there was one book that everybody should read and should start with, what's that?
Yes, this is a very good question. There are many number one books that people should read. One would be How to Tolerate an Intolerant Government. How to Live with Incompetent Governments. Now, this is a book. This is the most important book about inflation that has ever been written. It's called The Economics of Inflation. The author is Constantino Bresciano Turoni. I will show it to you. Can you see it?
Yeah, we can indeed. Just hold it a bit higher and we'll get the name of the author. Bit more. Yes. Very good.
Now, this is a fellow who worked at the Reichsbank between 1918 and 1924. And he describes in all details the impact of inflation on stock prices, on the foreign exchange market, on the price of gold, on wages, on on society, on the tendency of wealth agglomeration or wealth increase among big groups at the expense of the masses of people. This is the Bible of inflation. Everyone who is involved in economics and so forth should read it. Of course, American economists like Yellen and so forth, they have never read anything except nonsense, the modern monetary theory and Keynes and so forth. They have not read the classical economists. So this is a good start into economics.
And that book's over 100 years old and the learnings are still relevant today.
Yes, I think so.
Fantastic. I'm just going to ask you one final question, which is what's your best piece of advice for 2024 for the average investor?
Diversification. It's going to be very volatile. I'm convinced of that. With some stocks, we have NVIDIA going to the sky for now, and other stocks tumbling. And we will have especially a lot of volatility in precious metals, because the dollar, in my view, is a doomed currency, doom like doom. And the trend of the dollar's purchasing power will accelerate on the downside. In other words, cash money will lose value at an accelerating rate. Now, it may not happen so much against, say, currencies like the euro, or it may happen against Asian currencies, but especially against, say, cryptocurrencies or gold, silver, whereby if I look at the commodities complex, I find some commodities to be much cheaper than gold. Say wheat, corn, soybeans are very low. Copper is probably relatively cheap. Oil is very cheap compared to gold. So if World War III happens in the Middle East, I think you can assume that the oil price will not go down.
Dr. Marc Faber, it's been an absolute pleasure, as always, chatting to you.
Well, the pleasure, I don't know. It's my view.
It's definitely a pleasure, definitely informative, and always entertaining. Okay. And I look forward to the next time we get to catch up with you.
Yes, I'll give you another book next year.
Super. Thank you very much.
Great. Bye-bye. Take care.